Great. So I'd like to introduce this panel and just go down the line with 1 or 2 minutes of background on each of you. And Jonathan, why don't you start us out?
Thanks, Richard. Good afternoon, everyone. My name is Jonathan Bergman. I'm the president of TAG Associates. We're an $8 billion multifamily office. We're about 36 years old. We were one of the pioneers of the multifamily office space. I'm the president. I work with clients. I also oversee our private equity and private debt portfolios. At TAG, roughly 1/3 of our investment base is in alternative investments, and I probably have the distinction of having the shortest commute here since I just walked across the street.
Great. Thank you, Jonathan. Thomas?
Thomas Haug, managing member of Aspen Tree Advisory. Aspen Tree Advisory is a multifamily office based here in New York City. Also a partner in a fundless sponsor venture capital cooperative called IDI Group. I serve on the board of directors of a cannabis company called Pure Cali and serve on the advisory board of one of the largest New York Stock Exchange-based trading businesses called America's Executions. And that's me.
Great. Christina?
Hi, my name is...
There's a button on this side.
Okay, thank you. Hi, my name is Cristina Campabadal. I'm from Barcelona, Spain. I create my own multifamily office in Spain, and I'm managing director in Life Invest Wealth Management. It's an American family office here in New York. And my expertise is in families, ultra-high net worth clients from Latin America.
Great. Thank you. Paul?
Hi, Paul Kang. Our family started out in consumer products, and we've branched out to hotels and retail, and we have an insurance company and some other things, mostly in Korea and Japan, but we do have some operations around the world.
Great. Andy?
Andy and Anaway have a family office and also a private equity fund that invests in lower middle market consumer products and consumer services.
Great. So I want to go through some quick case studies now with each of you. Maybe we'll start with you, Jonathan, down here at the end. Just real quick, 1 to 2 minute stories, or 3 minutes maximum, just so we can get through a lot of questions on this panel. Take some from the audience in a couple minutes. Well, that sounds better. But if we could just do a quick case study on an investment you've made recently, how you sourced it, structured it, or any lesson you learned from doing it, I think it might be helpful to many in the room.
Sure. Well, I'll do 2, but I'll still meet your time requirements. One was a recent success, and that was through, we were one of the pioneers and founding members of a private debt group in New York. And because of that relationship, they've offered us co-investment opportunities in everything they do, no fees, no carry. And they bought the first and second lien debt of an NHL hockey team. Now, we would never invest in the equity of a sports team. Typically, it's well, it can be lucrative. It tends to be more about cocktail parties and power and being on TV. But the economics on this deal were quite impressive. And there was a game plan knowing that the team would either succeed financially rapidly or the team would be forced to sell. And there was a massive exit fee for the debt holders upon sale. So the sooner they sold, the better it was for us. So we made an investment a couple of years ago, and in less than 2 years, we earned 1.4 times our money, 20% net IRR. And again, it's debt, so it's first and second lien debt. So we were very comfortable in that, and we actually rooted for the hockey team for a few minutes and no longer need to. That's one deal, and that just closed recently. Another deal that we closed this week, and there was on the previous panel, someone mentioned, is it a trend or is it a fad? Well, we spend a lot of time thinking through new ideas. Is it a trend or is it a fad? The most recent investment we made is co-investment in the largest U.S. pea protein provider. That's yellow peas, and that is the chief ingredient in Beyond Meat. They also supply to Nestle and Vega and other plant-based protein providers. So we spent a lot of time figuring out, is the shift to plant-based protein, is that just a fad at the moment, or is this really taking off? And ultimately, we concluded that it's really taking off, and we, along with one of the largest food manufacturers in the world, invested in this company. Again, we're closing this week, and we actually sourced it from a client. A client of ours sourced this deal and introduced us to it, and we did a tremendous amount of diligence, and we're really excited about it. And we've been celebrating by eating Beyond Sausage and Beyond Meats and Impossible Burgers.
Great. Thanks, Jonathan. Thomas, what about yourself?
So I'll talk about two. So as I mentioned, IDI Group is a fundless sponsor venture capital cooperative, 6 founding partners, about 6 affiliate partners in the group. So what we do as a collective is we identify venture stage companies where we go in, invest in these companies, make our commitment, and then find friends and family to syndicate portions of that deal out to. One very interesting company that we recently invested in is a company called Ebby, Empowered by You. It was founded by Sofia Vergara. It's a subscription-based women's underwear company with a microfinance component, empowering women in other countries to start businesses. That's a company where we definitely bet on the jockey, and so far it has been a very, very, very good relationship, good working relationship. Another company is a company called Snapback, which is hot and cold compression wearables technology. It had a $23 million pre-money. We went in for $7 million, and our exit is probably 2 to 4 years there, and it'll be to one of the likely brands. So that said, I think both of those companies, we got in very early. We have conviction in the management teams. We have conviction in the companies, and the illiquidity premium in those cases are very much worth it.
Great. Christina?
I will speak about just one investment. It's very special because it's a fund, a North American fund. It's about cancer research. The National Foundation of Cancer here in U.S. Is helping to found to this fund some startups that invest in investigation and different kind of cancer, and we invest there. And you know what I learned? That you can make money and save lives and help people too. So that's why.
Great. Thank you. Paul?
I think Richard makes a great point that we as investors have to be pretty proactive in terms of sourcing transactions. And one of the speakers earlier was talking about looking for, decacorns and everything else. But I think if you are not one of the, 4 or 5 people that Zuckerberg knew at Harvard when he asked to raise money initially, or if you weren't a Stanford professor, you didn't get to invest in Google. And so, I think that it does make sense to really do a proactive effort. In terms of my example, we do a lot of borrowing funds, but one of the things that we do like is biotech. And so we actually created a couple of joint ventures with a couple of research institutes in the U.S. and have started to invest alongside them. And there's one where we started out, I think we made a $2 million investment. We're up to about 70 now, and we think that we'll be able to take this thing public for over $1 billion later on this year. So that was a great story for us.
Great. Andy?
In our first fund, we invested in a experiential entertainment business. We felt that it was a great platform. We thought we could add more diversity into it. We have a very strong ESG component in our fund and in our investment thesis, so we implemented some of our ESG focuses to this. We brought in a new management team, professionalized the group. We're able to do a few partnerships with the likes of Universal Studios, Nickelodeon. We did a small tuck-in acquisition and bought the license rights to Sesame Street Live touring. In 3.5 years, we were able to double EBITDA. This was a deal we did with no debt because the selling family was adverse to debt. So in a deal with no debt, we were able to triple top-line revenue, double EBITDA in 3.5 years, and sold the business to Cirque du Soleil for about 2.3 times the money in a little bit less than 4 years.
Great. So I want to make sure that since you guys took the time to come here and speak on stage, that you leave with some deal flow that fits what you guys are looking to allocate to right now. So in 5 words or less, what's the most valuable piece of deal flow or type of investment that you're looking to source? Maybe we can start with you, Andy, and work our way down towards Jonathan here.
Yeah, we invest only in family businesses or Hispanic-focused businesses here within the United States in the consumer products or consumer service segments.
Great. Paul?
So we're 80% in funds in all different classes. Then we do real estate, biotech, and some private equity, especially in the consumer space.
Christina?
We invest in real estate in US, in technology, in classic cars, and something we are fans that we are looking all the time over the world.
Okay. Thomas?
Private equity, private companies, real estate, private debt and credit, and I would say anything that has an impact component to it that is a phenomenal investment standing alone from it being an impact deal.
Jonathan?
Well, I'll adhere to your 5-word limit.
Thank you.
Niche, inefficient industry, but understandable.
Great. And you mentioned overseeing the debt area on top of being, president of TAG. So can you explain just a little bit your thoughts on debt in terms of where you're allocating? There's many ways to get exposure, debt exposure, and I know you guys have the sophistication, one of the more sophisticated shops in the Northeast that's a multi-billion-dollar family office. So how do you think about that within your investment committee and team, and where do you actually invest your energy into finding the best within that part of the market that you want exposure in?
So we love private debt. Unfortunately, the secret is out, and we like it a lot less. We've been investors in private debt for a number of years. It was a natural transition away from fixed income markets as rates had come down and covenants had gotten too loose. We went for really private deals, initially with funds in niche strategies, differentiated strategies, not middle market lending to private equity funds because that is just too competitive. So we went further and further away from the center of the fairway, and we've had great success. But when every fund that we invested in 5-6 years ago came back to market and said, would you like to double or triple your investment amount, commitment amount, we said no. The market is too competitive right now. There's too many people lending with insufficient covenants, insufficient guardrails, and they're lending too cheaply. So what we've done in the last couple of years, and I highlighted it with the hockey team, is we're just doing specific deals. We don't want to lend into this environment broadly. We're only looking for unique, differentiated deals where we think we've got strong collateral, tight covenants, and high yields.
So I know you went niche and efficient. I know you go direct to some debt deals to negotiate great terms and you have full transparency on the actual deal. But what do you guys talk about internally that's exciting, super inefficient, and you'd want to get that flow from the event room here today that's super specific, you think?
I don't know what it is, but I can tell you, we just did the pea protein deal. We invested in we like funds that are $250 million. Not huge, not tiny, but where we can be a meaningful investor, and they're operating typically in a less efficient market. So one fund we did recently was a UK-based fund, private equity fund that's a public-to-private strategy. So in the face of Brexit, not many people are allocating dollars, or pounds rather, to the UK, and we just did, and we're a meaningful investor. And the UK small cap market is the most inefficient market in the developed world. And we really like the dynamics there. We like the rule of law in Britain. And these companies, the public companies, are trading at 10-year lows. You can't really say that about many developed markets. So we love the opportunity to go in there and buy these companies, take them private, fix them up a little bit in a traditional lower middle market strategy, and then sell them to private equity firms later.
Great. And Paul, for family offices and private investors here in the room, what's your number one piece of advice for proactively going after deal flow and sourcing, as you called it, boring fund managers in the marketplace? You've spoken at several of our events and have been doing this for a while. So what's a piece of advice you could lend to them in the audience who would like to take action on your advice?
So one of the key things we try to do is, to be diligent in terms of the deal flow that we do get, and as I've spoken, as Richard has mentioned in the past, is that when people like us come to these things, you have a few opportunities to reach out to us, and whether it's your elevator pitch when we might meet in the hallway, what's on your business card. What you say, hopefully briefly in your email, and hopefully an impactful presentation. They're all pieces of I think things that make an impression, and we certainly try to be very diligent in looking at every email that comes across our desk, and try not to be too biased in terms of dismissing things, but it does help us if you can help us with the steps in the process.
Great. And Thomas, you brought up impact investing. Sometimes people put the impact label on just about anything. They're buying an apartment building, charging $10K, putting $10K renovation on it, charging more for rent the next quarter. And they say, oh, we're improving the lives of the tenants because it's a nicer building now, to things that really make a drastic improvement in someone's life, whether it's access to water, et cetera. So for you, in terms of how you approach the space and how much of a problem and how much that just kind of muddies the water on your ability to actually source impact investments, can you comment both on that and just the feeling that impact investments gets talked about a lot everywhere, especially in the media and sometimes at conferences, but only a percentage of family offices really look for impact investments. So for those here in the room, if you have any advice on other ways to connect with families who want impact investments, I think that might be helpful.
Sure. So first I could talk about, someone that I'm relatively close to, who went out and put repurposed jet engines on barges in areas of Africa that did not have electricity. I think that's a genuine, impact investment. You could talk about EBI, microfinance component empowering women to start businesses in other countries. You can talk about an opportunity zone investment fund of two that I was active in, the only LP investment in this opportunity zone fund of two, Puerto Rico only after Hurricane Maria. So I urge everyone to look at impact. I don't want to say impact second, but I think the deal has to make sense without it being impact centric, right? So of course, it's a better investment and it makes everyone feel good and everyone talks about impact investments. But I think impact's a very hot word, and you have to drill down with those jockeys that are running that investment and really understand what impact they're making, why they're making that impact, and what their ultimate goal and mission is. If it is impact first and investing second, probably a pass for us.
Anyone else want to comment on impact investing before I move on to the next question?
Yeah, for me, I think that the key is look for innovation, sustainability, and honest people or honest managers.
Right, great. Yeah, I think sometimes if you try to use it as a marketing spin, it just kind of backfires and takes away from the credibility of the project potentially. So I think it's good to be careful on that. We're going to open it up for questions here in just a minute, and we have 1 or 2 microphones to bring to people in the audience. If you want to start raising your hand now, we can weave through the audience and get a mic in your hands by the time that we take the question. Feel free to raise your hand, and we'll start doing that. I'd like to go down the line just with a quick kind of one-sentence answer, if we can, maybe starting with you, Andy, on what's most important when you're looking at a company or a potential team that's behind an investment or an organization in terms of long track record, whether it's a unique niche strategy, how long you've known the manager in terms of like seeing them grow over a couple years or many years ideally, or another factor that I know all of those things are important and like 30 things need to be lined up to even really take a serious meeting with someone probably. But what do you pay attention to first that is most critical within your team and really clears out most people you find that approach you to seek your partnership and capital?
Yeah, so when we invest in business, obviously all those things are important. The team, whether we need to replace the team or supplement the team. I would say what's most important is a pathway to success and how we can help them achieve that, right? I'm an operator, so I grew up operating businesses. My partners in the fund are more traditional private equity people. But as long as we can, pencil out a 2.5 times return and a pathway to that with our ability to help achieve that goal more efficiently, more quickly, and sustainably, that's kind of what we look for.
So it sounds like you have capabilities to help improve the team. Obviously, usually in the consumer space, there's help with getting distribution. That's usually a big part of the success. But can you speak just for 1 minute about that unique ability in case there's a consumer products company here that maybe could use the expertise even more than the capital that you could bring to the table?
Yeah, and we're much less about needs of capital than needs of help or desire for help or succession planning. But yeah, I grew up running a consumer products business called Goya Foods, the largest Hispanic food company in the country. Helped bring that company national, helped develop the evolution of how we went to market, getting into the general market from specifically the Hispanic market, and all those connections we have in the teams I've known throughout the country from my past 25, 30 years in the industry helps us implement those strategies and achieve the goals we're looking to get.
Great. Yeah, it makes sense. I think that comment you made is really one of the more important comments I think on stage today, that it is about the expertise more than the capital, because it might seem stressful during a capital raise to find the capital provider, but at the macro sense of it, when you look at the industry, there's lots of capital all over the place. And the entrepreneur will give better terms, or they want to close the deal with the person who's going to take them to the $100 million a year in revenue or take them to the exit, et cetera. So many times that's what drives who actually gets the better terms and who gets the next meeting.
And I would also say respect for corporate culture. Like I said, we mainly invest in family businesses. I grew up in a family business, understanding the pitfalls, the downfalls, and the upside of family businesses, trying to maintain that culture and be able to expand what that culture can do in a more professional, sustainable, growth-oriented model is extremely important to me, and the legacy of what that family will have long after we all exit together.
Sure, that makes sense. I think a lot of family business owners are scared of being Whartonized by people that went to schools that are very famous and well-known, and with a team of lawyers or 12 people that all went to Harvard or Wharton, the 72-page legal agreement, they don't really understand all the terms, and they're afraid of what they mean, so they just back away and just don't want to work with any investors that come in like that because they think it's a vulture approach potentially. Paul, in your case, you say you look at boring fund managers. In my mind, that means boringly stable, been around a long time. What are you looking for first? Is it that really long track record? Is it stability of returns? Or is it a niche play, but somehow they've been around for a long time already? Or
So a while ago, one of the things we did, of course, was to take a look at what happened to them during the crisis, and that would teach us something about how their strategy really kind of got through those tough times. But I think, as many of you know, if you always have top quartile managers, you'll do okay in pretty much any environment, but that's not always easy to do. We certainly believe that, especially these days, beta is driving returns more than alpha. And if I might mention that, we think one of the biggest bubbles right now is the shift from, public to private assets. And 5-6 years ago, I would have been in this room and everyone would have been rah-rah, let's invest in real estate and everything else. 2 years ago, you started to hear people talk about, well, we may go into a real estate asset, but we need to make sure we've got the leases and we've got the ability to refinance our debt and those kinds of things. And so, you are seeing some adjustments in the marketplace. And our 2 cents is that going forward, you need to take a look at your liquidity more and more. And whether it's even things like, do you have exit scenarios or provisions when you go out there and buy a company? Do you have the ability to refinance things? What portion of your assets are in cash? Because we have to admit, we are more in cash than we probably have ever been. And so, I would leave you with that.
Sure. Christina, what's the number one thing you look for?
We look always for exclusive and unique investments, because sometimes it's not a long history of the fund. It's not always the best choice. It's some startups that are amazing on technology here in New York that they started like 2 years ago, and it's something great to invest. So I think that should be invest in something that you never see before. It's something special, and the people who is close to this deal is intelligent, smart, and have something.
Sure. Okay. Thomas, what's the number one thing?
So I'm going to regurgitate a lot of things that everyone else on the panel has said, but I think culture is very important. Built a big portion of my career at First Republic Bank and Investment Management. If anyone knows the firm, they know they have a very strong culture. And that does not always translate when you try to grow a business, and the partners that you invest in, especially in the private company world, sitting down and really having a heart-to-heart with those people to say, what are your plans for growth? What are your plans for growth within management? Who are you going to be to us as a partner? And how can we help you grow your business? Because ultimately, if we help them grow their business, they are going to be more successful. But if everyone's not speaking the same language, that could become a challenge. And then separately, I would also say diligence.
Great. And Jonathan, I'm pretty familiar with some of how the large multifamily offices work, and it becomes pretty institutional with 162 checkpoints and a big team of analysts, and usually looking for so much of a track record, so much in AUM. So I would imagine that a lot of the very fundamental things knock out a lot of people, but what's something that you could share with the room on what matters the most and moves the needle, either on the negative side or what helps get someone in the door that might be an exception to some of those rules?
Right. Well, that question is a loaded question. It's like asking which of my children do I like best. It really depends on the day.
Which one?
Yeah. But notwithstanding every checkpoint, I think Paul said this. We think we are very late cycle, obviously, and beta has been the play for the last 10 years. We're thinking more about alpha. We're thinking more about idiosyncratic returns. So that's pushing us more toward direct deals, co-investments, and then in funds in niche spaces, smaller funds and niche-oriented funds, where we can do a first-time fund, but that is, there's 3x the diligence compared to a fund 2, fund 3. But we really want to be operating in categories that not everyone has invested in thus far. So we loved private debt 5, 6, 7 years ago, like it less now. We invested in cannabis a handful of years ago, not as much now. So we're really looking to where the puck is going. to use the hockey reference because that was a successful deal for us. And we want to be in something that hasn't been picked over and not where everyone else has gone. And in fact, family offices have an advantage, even though we are somewhat fairly institutional, and we do have maybe not 162, but we have many checkpoints. Family offices have an opportunity and an advantage that institutions don't have because they can do a fund one, because they can invest in cannabis, which is federally illegal. In other categories, we have an advantage. We don't have an advantage on total dollars compared to a pension plan, but we have an advantage on nimbleness, and we have an advantage on breadth.
Great, thank you. The number one thing that my clients are often looking for is some sort of arbitrage. They're taking a deal that produces enough profit that they can bring in a high net worth investor and just pay them a debt note with collateral, and the investor feels safe, and they get to keep the upside when they know that the asset's going to serve that debt note fine. They have more equity at the end of the day, doing deals as a co-GP instead of always as an LP. Like Andy said, doing a deal where you have strategic value, so you're getting a better valuation, and the CEO knows that. It's not that they're ignorant, but they're giving you that valuation because they want you to say yes, buy 5%, and be on their board. Taking a company public from being private is a form of arbitrage. Buying a company on a multiple of EBITDA, and then you sell it to private equity at a 10 times EBITDA instead of buying them at 3 to 4 and stacking 2 or 3 on top of each other. Or buying a company at a multiple of EBITDA and selling it on a multiple of revenue to a big strategic who's gobbling up companies once they get big enough. Or just buying a single-family home and turning it into Airbnb is another form of arbitrage. So it's looking for some form of arbitrage. I guess summarizes the whole investment industry, but family offices want to feel smart and actually be smart and defend themselves against what's happening in the greater marketplace, obviously. So that's one key thing we're always looking for. Any questions from the audience? Yes, we got one in the middle there. Alan, do you have a microphone you can take back there? Oh, Charlie's coming up to the middle. If you can raise your hand again, sir. There we go.
I was just wondering how far down the investment chain does the high wealth or high income funds look for, your funds look for? Does it go down to the seed level? Does it go down only to the secondary equity level?
I know Jonathan talked about sometimes getting in very early and having that capability, at least. I think that's what you're asking, right? Can you come in on an A round or a seed round on a deal or a fund? Does anyone want to comment on that?
Well, we're not typically going to do an A through C in a portfolio company. What I was alluding to earlier was a first-time fund. And if it's a first-time fund, it's going to be a tremendous amount more diligence and more examination than if it was Fund 3, at least on the operational standpoint.
We'll do early stage things. One thing that I'm not sure U.S. investors do as much of, but if you go to China, if somebody finds a great industry, I don't know, let's say it's tofu making in Beijing, and there may be 10 great companies in that space, a Chinese VC may invest in 8 of them and say, hey, we don't know which one's going to be the winner, but we like the space, we're going to invest in a bunch of them. And we have to admit, in things like biotech, when it's immuno-oncology, we don't really know who the real winner is going to be. So we may invest in several of them just because we like the space.
Good.
And then for us, and I'll speak on behalf of IDI, not Aspen Tree, and this is not choosing managers, but it's choosing companies. When we look at a company that's very early stage that needs our help from a capital standpoint, we look at the same thing we would look at from a younger alpha generating manager, a spin out story, prior success, the company they're associated with. So for example, Snapback, the CEO prior to running Snapback, he was a relatively high level individual at Adidas. Right. So I think it's important to understand what their backstory is and what their prior successes were, and that gives us conviction in investing in those companies and individuals earlier on.
Great, thank you. I think we had 1 or 2 more questions. Yes, up front. Thanks.
Thank you. Thank you. Following the manifestations last Friday and Greta Thunberg's appeal to the UN and world leaders the other day, do you expect to see more investments profitable in sustainable technologies?
So the question was, do you expect to see more investments in sustainable technologies like energy, sustainable energy technologies? No comments on that one. I mean, personally, I think that there is always going to be more investments in energy, sustainable energy technologies. I mean, we're seeing that with GM saying they're not going to manufacture any more, gasoline engine cars coming up real soon. So I think that speaks to it. FPL is putting in throughout Florida massive solar fields, and we know of a family doing a ton of work in solar field installation and investment right now. So I see it from my perspective far more than I see let's have a formal impact investment program. I see the energy efficiency investments growing. Another question?
Yeah. Hi. What's the interest of any of you guys in healthcare, specifically non-secure account receivables or pre-settlement funding, particularly in New York?
Any interest in healthcare?
Am I clear or?
Yeah, so we could talk offline. I've been relatively active in the factor-based advance space, not necessarily on receivables advance, but more on the merchant service advance space. So we could talk after the panel.
Back along the wall, yes.
Yeah, just one quick question. I think 3 or 4 of y'all said real estate interest. Can you give us a little bit more specifics so that you don't get bombarded? Is there a type of, is it commercial, residential, industrial, office, that kind of thing? And are y'all more focused on acquisitions or new construction, those type of things? That way you don't get bombarded with stuff you're not interested in.
Yeah, and we only have maybe 30 seconds per person, so just maybe asset type, and what type of property and what type of real estate, if anyone wants to comment on that.
For us, we're steering out of the gateway cities, so probably smaller cities, looking at multifamily, student housing, mixed-use properties. We're looking at some interesting kind of redevelopments of usual malls. So a little bit of variety there.
We are looking always in not small cities, because cities like Dallas and Denver are not small, but I mean it's not like New York or Miami, and normally are residential.
We have a lot of exposure to multifamily value add southeast, so I would say not as much. Longer term commercial, mixed use, in unique markets with operators that have skin in the game.
Great. Maybe we have time for these 2 or 3 quick questions here. I think she's on your team, Jacques. Is that right? Great. Oh, okay. I thought you could. How about you two over there? And then, sure. We have one behind you, and then we'll make sure to get your question, too.
In a low-rate environment, are you looking at cash flows in the deals or just looking for, the multiple expansion?
Yes. It depends on the deal. I mean, I love cash flow. My clients love cash flow. The market is very efficient, and there's so much capital awash in the world that everything or many things get priced right. But yeah, we're looking for yield, and then or we're looking for growth. On my pea protein deal, I'm not going to get a cent until they sell. On another deal we did recently, we're getting paid almost on day one.
Well, I would only add to that we would actually go to the extent of recapitalizing to take out as much money as possible, because we know that we can put money back in if we have to, but we may as well try to take you out as much as possible going along the way.
Great.
We all know that connected and autonomous vehicles are the future. In order for those vehicles to operate on our roads, they require digital roadside infrastructure. Ontario Teachers Pension Plan announced a joint venture with Google's Alphabet a week and a half ago about investing in roadside infrastructure. I haven't heard anybody talk about the importance of digital roadside infrastructure, and I'm just wondering if you guys are hearing about it at all.
I do know I came up with a super summit last year, and I think at the SFO summit in Q1 this year. But I didn't hear it earlier as well during the event, but I might have missed it. Does anyone want to comment on that trend or any investments they're doing related to that?
Now, one thing I would say is that's a prime example of an area that I'm not too familiar with. I would love to hear more, but once again, I think anyone feeding us information has to have the patience to continue to do that until we have conviction in the space. So any updates would be great.
And I think that connects to one thing I found is helpful to many people who are looking for an investor is to find people who have already had exits in the space, already allocating to the space, and you can do so by having someone do data research for you or looking at old Inc. 500 lists or who's on the boards of publicly traded companies, et cetera, and build up that list of 300 to 500 people who already know your space very well, so you don't have to educate them on it, even though a part of your investor base might be people you have to educate over time. If you spend 80% of your energy on ones you don't have to educate as much, then usually it really helps and they add more strategic value. I want to give the panelists a chance just for 30 seconds or less, anything you really wanted to get across in the panel. I know we didn't get to all the questions here, but just real quick, any last ideas that any of you would like to share with the audience that's for investors or people raising capital here today? Not all at once. Andy?
I would just say if you are looking to partner or exit your family business, make sure you pick the right partner. Capital isn't everything. Your corporate culture, your legacy, how you're going to be treated through the hold period with your partners is extremely important. Obviously, the price is important, but you should make sure that the culture and your partner is probably just as important, if not more important.
Right, I think it's a great point. The team can be more important than price. Sometimes the structure is more important than price, too. A more aligned structure or a fair structure on a waterfall can mean a lot more than getting a top dollar valuation. Christina?
Yeah, now maybe it's the moment to say that I'm looking for a registered investment advisor here in US to buy the 51% of the firm. So if someone knows RIA that they have 1 billion under management, just please let me know.
Great, thank you. Any last comments otherwise? Before we break, I have just 1 minute of things I have to run through real quick. We then have the sponsor for the cocktails is going to come up for literally 2 minutes to share one thing with you, and then we're going to break for cocktail networking in just 2 minutes. But I'd like the discussion panelists to stay here so there's not a mob and a lot of networking going on while we're trying to talk here. The last comment I wanted to make is that related to the arbitrage comments I made is that I think if family offices can focus on what they're excellent at, there's not a lot of competition for, but there's lots of demand, then if you can focus most of your energy on that sub area, then things go better. We're going to be getting a few video testimonials today. Charlie's going to be up here at 5 p.m. In just about 10 minutes to take a few of those. If you've been a client or been with us and gotten some deals done or had a great time in the community, then please let him know, or maybe recording 5 or 10 of those here. Jennifer can help you with a walkthrough of the portal. If you're a new member, make sure you do that because there's a lot of benefits of being a member besides coming to one of the 32 events we're going to have over the next 14 months here. One of those benefits is a capital raising audit. So every 3 months, we'll analyze your pitch deck, website, all your materials, and give you feedback on what we would consider changing if we were in your spot. You might not agree with half of it, but I'm sure there's going to be a couple ideas that are going to get the wheels turning or things that are reminding you of things you know you need to get fixed up. If you want to see the performance-only work we do on the direct investment side with family offices, we don't do wealth management, but that's at centamillionaires.com. If you want to speak at one of our future events, see Vanessa or Ellie. If you have questions about pitchdecks.com, that's Andres. We've got the sponsors, and we have cocktails outside there. I'd encourage you to just take one lap around the sponsor room, make sure there's not someone there that you could do business with or work with from the event today. We appreciate that support, and that's why we're able to do these events right in Midtown and not at a more remote location with worse food. So we definitely appreciate the support of the sponsors and all the speakers that took their time to be up here today. As I mentioned earlier, none of the speakers are paid to come up here as a keynote speaker. They're here because they want to get deals done. They want to source deals, source managers, learn from each other, and have better deal flow. That's why they all say what their investor mandates are on stage. And Alan, if you don't mind coming up to have the video switch over, Charlie. Paula Sanders is going to come up real quick now. Her firm is the cocktail sponsor for this afternoon. And we know that coming to these events is all about making connections to get deals done. So I'm glad all of you stuck around for the whole day. And I want to make sure that you know that we have on October 15th, a Family Office Fundamentals Workshop in Miami. October 29th, we're going to be in Dallas for the Real Estate Private Investor Summit. Similar format of this, but about half the size. I'm very focused on real estate, obviously. November 12th, we're at the Raffles Hotel in Singapore for Family Office Fundamentals. And then the 1,000-person Family Office Super Summit is on the island of Key Biscayne, which is 10 minutes from downtown Miami, at the Ritz-Carlton on the 16th and 17th of December. All those dates are on familyoffices.com. But let's have Paula come up, and then when she's done, she's going to release you to the cocktails and networking. So thanks for your attention for just the next 2 minutes here.
Thank you so much for the introduction, Richard, and thank you for having us today as your event sponsor. As he said, my name is Paula Sanders, and I'm the VP of Membership at Insignia. And since we have such little time with you guys up here on the stage, and it's been great to meet a lot of you today, and we're looking forward to meeting the rest of you during the event, I'm just going to let my video do the talking because it really tells you all about Insignia. So I want to introduce you all to Insignia and have you start saying yes to impossible. And I'm sure you all have a lot of questions, and that's exactly why we do that. So please feel free to come ask me anything about Insignia. I brought along some of my incredible teammates. They're in the back, over there to your left. Please come see us. Have an amazing time. It's time to let loose, have some cocktails. Cheers to you all. Have a great night.
Thank you, everyone.